Welcome to the Lend Academy podcast, episode number 163. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's show is sponsored by Lend It Fintech USA 2019, the world's leading event in financial services innovation. It's coming up on April 8th and 9th, 2019 at Moscone West in San Francisco. We've recently opened registration as well as speaker applications. You can find out more by going to lendit.com/USA. Today on the show, I am delighted to welcome Angela Ceresnie. Angela is the CEO of Climb Credit, but many people would know of her from her time at Orchard, where she was one of the co-founders. But she's actually been at Climb Credit for a couple of years now and recently became CEO. So I wanted to get her on the show to talk about Climb Credit. They're a fascinating company. They believe that education is an investment and should be treated that way. And I completely agree. And so we talk about their mission and how they're really working to help students obtain degrees. We go into some depth about how they approve schools onto their platform, how they approve students to get a loan. We talk about the problem with the whole student loan system overall and why it needs to move more towards this sort of idea of education as an investment with an ROI. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Angela.
Thank you. Excited to be here.
So I like to get these things started by giving the listeners a little bit of background. I know many people know you in this industry, but still would be good to get the background about yourself, what you've done before Climb Credit.
Yeah, great. So I started my career at American Express and then at Citibank on the credit side. So I managed consumer credit risk and analytics at Amex and then small business risk and analytics at Citibank. And that was about 9 years of experience just in terms of learning the basics of how credit markets work and specifically how credit works for individuals. Great learning experience. I left in 2012 to start a company called Orchard, which obviously you know, and I think many of your listeners probably know, with several other co-founders, leveraging a lot of the experience that I had from Amex and Citi on the credit side. So Orchard's initial business model was providing active investors on Prosper and Lending Club tools to figure out which loans they should buy, actually buy those loans, and then manage their portfolios on the back end. So, and I was sort of part of the team that created the initial models that we would share with our investor clients. So that was just such a fabulous experience scaling a business, bringing on institutional customers, building out a B2B sales team, building a product and, kind of fighting for product market fit and understanding kind of the day-to-day of running a business that's scaling. In 2016, I joined Climb initially as the COO, and now I've transitioned into the CEO role. But one of the great things about Climb, and we can get into the business here, but is that it enabled me to get back into the lending business directly. So kind of back to my roots of actually making loans to people who need them.
Mm-hmm. Sure. So I know, like we actually first met. I think it was before Orchard. It was one of those meetups that when there was like 25 people in the initial early meetups, and I know you and Matt Burton spoke at the very first Lend It, and we've been following. We've sort of been following your career since then. But I'm curious about what was specifically. You talked about the getting back to your roots. Being actually a part of a lending platform. So, but there's many of those out there. What specifically attracted you to Climb Credit?
Yeah, so there's, I would say, three kind of pillars of our business model that have existed from the beginning and are kind of key to the success that we've seen to date. So we're an education finance company, and we partner with programs and then offer loans to their students. And I'd say that the first and probably most important part of the business is that we are a mission-based company. in that we only partner with quality programs. So our mission is expand access to quality education, and we do that by doing a fairly robust diligence of every school and program that we work with to ensure that the program is delivering results, quantifiable results to the students who attend. So that was, that to me was kind of first and foremost great, because if you're going to be giving credit to people to go do something in their lives, and as a credit provider, you have some point of view and some level of sort of check that thing that you're enabling someone to do will have at least a reasonable chance of having a positive impact. That's really great.
Right. So I want to actually dig into that a little bit, because you talked about, when you first said high quality program, that feels like a pretty subjective assessment. But what it sounds like you're saying, this is quantifiable. The fact that a program is high quality is truly quantifiable. So what does that mean? How are you quantifying these programs that you decide to work with?
Yeah, no, so you're absolutely right. Quality is inherently subjective. So what we did was we created what we call our return on educational investment calculation. And what we do is we essentially assess the actual impact to someone's earning potential from attending a program versus not by gathering data from that program and other data sources to understand kind of what's happened historically. So first you have sort of where most people who enter that program are starting from. So does as an example, a welding school in Ohio, are they typically taking people with a high school degree, or do most people come in with a bachelor's? Okay. And based on that, you kind of have an idea of where some people are coming from. And then what's the percentage of students who actually graduate? What percentage of those students actually get jobs upon graduation, and how much money do those jobs typically get for people? So that you kind of understand the upside, the potential upside, and then the downside is that you have to pay for it, right? And you have to take time out of the workforce. And so we kind of compare that scenario to the scenario of essentially just keep going with wherever the person started with, and don't take time out of the workforce, and don't pay for the program. And we ensure that differential is positive.
Mm-hmm. Mm-hmm. Sure. So are you just primarily working with vocational schools and things like coding boot camps and that sort of thing, not 4-year degree programs?
Correct. So our target market is career and vocational schools, and we really define that as schools that lead directly to either a new career for somebody or a enhanced earning ability in an existing career. Mm-hmm. So the first example might be a coding boot camp, a truck driving school, a welding program, kind of any number of careers where you can, or programs where you can go in and then essentially transform your earning potential. And then also we work with a number of programs, some IT programs, some online master's degrees that take people who are in existing careers and enable them to earn more. Mm-hmm. So one clear example of that is we work with a master's in education program that takes working teachers, and then those teachers, once they get the master's degree, it costs about $8,000. They get an automatic pay bump in most school districts as a result. Right,
got it. Now that makes sense. I mean, I can see how this. You can gather in the data and really get a pretty accurate assessment, I imagine, on averages for salary bumps and it just becomes a mathematical equation, for right. a lot of this sort of thing. So I want to take a step back for a second, and I mean you're addressing a certain part of the student of sort of the what do you call the student loan problem, shall we say. But when you look, I have conversations with people on a regular basis who are in the student loan business, or who are students with, who are graduates with huge student loan debts. And I think it's now like 1.5 or either 1.5 or 1.4 trillion. What's $100 billion?
That's right.
Something like that.
Yeah.
But it's massive. And I feel like it's unsustainable. I'd like to get your take on, what are the biggest challenges with higher education in general today, and what really needs to change?
Yeah, so I think that, we obviously do a lot of thinking about that and kind of considering that in our day-to-day business. And some of the stats that I think are really astounding to me is, one, 30% of graduating high school students don't even go get a bachelor's degree, okay? And 40% of the people who start a bachelor's degree don't finish in 6 years.
Mm-hmm.
So now there's a lot of other problems in higher education and in the way we finance things. But to me, that is Climb's addressable market, and that's the problem we're trying to solve, which is that as of right now, for a vast majority or a very large percentage of our American public and young people, the current system of graduating high school and then going to like some system, some higher education, institution of higher education, and just taking on whatever debt comes along with that isn't working. Mm-hmm. And so what we're trying to do here is create the right financial products so that the career training programs that do add a lot of value, are far lower cost and therefore lower risk, and can be a great alternative even in the short run for somebody who's maybe not sure what they want to do, to create the financial products that really enable and open up access to those programs, to that kind of education.
Just one more point on this before we move on to more practical matters. Because I know you have young kids, I have young kids, and I think about what's higher education is going to be like when they are, I have a 9 and 11-year-old, and they're, so like my 11-year-old is just about to go into 6th grade. So it's not that far out, another few years before we have to decide. But I just wonder, to me, you can't keep going on like this. Are we going to get to $2 trillion, $3 trillion, $4 trillion, $5 trillion in student loan debt? I mean, that's sort of, if you look at, we didn't cross $1 trillion that long ago. And eventually it feels like your approach at Climb Credit really should be applied to the entire education system. I mean, once you finish high school, for example, for one of my wife's friends, my wife was in social work for a while, and one of her friends went back to Denver University, an expensive private university, for a master's that cost an absolute fortune, and her pay was still going to be really mediocre at the end of it. And to me, I was like, there's just no ROI on getting a master's in social work. I hate to say that as just picking one piece as an example that, right. If it costs you $80,000 and you're going to get a $5,000 a year bump in pay, that's, and then you got to pay interest.
Doesn't make any sense.
You got to pay interest on the loan. It doesn't make any sense. But so it seems to me that I think we're ripe for a transformation in higher education where it all goes down to what is the ROI. And if there's no ROI, you see it now already. There's some of the MBA schools have closed down because that's a real ROI oriented decision. But I'd like to hear your thoughts on it.
Yeah, so I think, we see this all the time because as part of our business, as I mentioned, we diligence every school. And we have, seen schools where when we look at the data, we say, listen, you're actually, you're getting people jobs, but for $50,000, $60,000 tuition, if that job is going to pay somebody $35,000 coming out, that doesn't make any sense. And the reason that schools are typically able to get away with that is because the federal government funds it.
Right.
So you can go to, so I'm going to pick on culinary schools. There are some great culinary schools out there, but you can go to culinary school and get it costs $50,000 or something, right? So you get a pretty big loan. You come out, you're working in a kitchen, right? You're not making a ton of money at first. And the reason they can get away with that is because if you're getting a federal loan going to that program, you can just defer it. You can defer it because you're not making enough money. Right. And so then, so you just have no alignment of incentives because the school got all their money up front from the federal government, basically, right? So they get the $50,000 up front, so they don't really care. And then the federal government is the federal government. So they're kind of like cool to defer because they're not like beholden to, make, a return necessarily on that one loan, right? So the person holding the bag is the student. And sure, that's great that there's deferral options, but is that really the answer for someone to just essentially be unable to make a debt payment and then be living in kind of perpetual, terror of, the fact that that's going to come due at some point? And so at the end of the day, I think there needs to be a kind of a reckoning on the whole system.
Yeah.
We're starting in an area where I think we can make the most immediate impact because it's the education that does pay for itself already. But my view is that, as we become, a larger and larger part of the education finance system, that other, schools will adjust their pricing and change the way that they think about the amount of money that students owe on the other end, not as how much can I get, but what's the right cost.
Right.
Right.
That makes sense. I think it's inevitable. Eventually, whether it's this decade or next decade, eventually there's going to be a reckoning where you're just going to see schools just not getting enrollment because if the ROI is not there, they're just going to suddenly see their enrollment shrink. And that's the way, if you're not providing an ROI, that's the whole purpose of getting a higher education really is to launch yourself into a career that provides you a decent income. But anyway, let's get back to the nitty gritty here. I want to, I want to talk about, you've touched on this already, but I'd like to just delve into a little bit on how you go about approving a school and how does the school come to you? Does a student come to you and say, I want to go to this school and you haven't approved? How does the process work and what's the data points that will cause a school to pass or fail your test sort of thing?
Right. So we get in touch with schools both ways. So we have schools who come to us. We have, schools that we reach out to. We have students who come to us that then direct us to schools. So it can vary. And we have a team of people whose job is to talk to the schools and essentially explain Climb's products, but then simultaneously better understand them and their data. But really, the crux of it is that ROI calculation that I talked about. So we get from the school as much data as they're willing to provide us on the types of students that they're educating, so the background of those students, so we have a better idea of the starting point, and then the graduation placement rates and typical salaries. And then we take that information that they give us. Sometimes it's kind of rolled up. Sometimes it's very granular, like student level info, anonymized. And then we sort of tend to pressure check that against either other schools that we know that are either in the area or teaching similar vocations and public data that's available. And, kind of one of the cool things about our model is that it's always learning. So as we work with, once we've worked with 3 or 4, let's say truck driving schools, that helps us underwrite the 5th, which then helps us underwrite the 6th and the 7th. And then we kind of really can get an understanding of who's doing a good job and who's really getting the students the outcomes they want. And then the great thing about that is that helps us in terms of from the capital market side of things and funding our loans, have the data to be able to make sure that everything's priced appropriately. And in a market like the one we're in, there's just not a lot of data out there on performance on loans, but also on performance of schools. And so that becomes a very valuable kind of, I would say, like sort of network effect within our own business of more growth. And the more business we do means like the smarter we can be at the next business that we do.
Right. But I imagine, some of this, you talk about like salaries of graduates. Some of that stuff would not be easy. If you can't verify that, I presume that's a non-starter then, right? Well, tell me this: where are the areas typically that happen? Is it that would prevent you from saying, right, we don't have enough data to approve this program?
Yeah. So one thing is it depends a little bit on the type of job that the school is preparing students for. So some jobs have a wide variety of sort of salary and potential outcome. Right. So actually, I would say like software development is one of those where, there's just a varying level of kind of software jobs that you can get, but we have a pretty good understanding within each market of what like an entry level job is. And so our assumption is that that's where the students are going, right? Unless they can provide us some data otherwise to show that they somehow get people, mid-tier jobs or something. But the main thing is, are the people getting jobs, right? And that's data that is easier to get in some ways because a lot of schools do keep track of it. And once we start working with a school, then we can start kind of getting that data ourselves because we start talking to the students and having interactions with the students. And so it can sort of also collect that data.
Right.
But other industries, it's pretty tight. Like if you, again, to get to the truck driving analogy, like most truck drivers starting salary, I think, is around $43,000 a year. And that's like pretty tight. You're not going to see someone come out and make as an entry level truck driver like $150,000 a year, I don't think.
Right.
You might get there, depending on how you get it, whatever, but that like there's a pretty tight kind of market. And what we want to do is, unless a school can truly prove to us that they're like giving some outsized return to most of their students, we just want to make sure that what they're doing makes sense for the baseline. Right. So if the baseline is 43,000, it needs to work at 43,000. If it doesn't, then I don't really care that there's the one outlier who, was able to somehow finagle some crazy salary.
Right.
So that's sort of our approach. But then we continue to monitor it. So we're also very keenly aware that, you don't want to be in the business of diligencing a partner one time and then just assuming that everything stays the same. So we go back and ask schools for more data on at least an annual basis. And then particularly if we have some reason to believe that maybe things are changing, if they add a new program, we re-diligence that program. We don't just add it, because we're already working with them. So we have some kind of pretty good checks that kind of continue to trigger throughout the life cycle of a school.
Right. And so then what about the borrower themselves? Like this, so a truck driving example, they go to the truck driving school, someone comes along and says, I can't afford to pay this. I need to finance it. And, they come to you. What's the underwriting process there?
Right. So that actually, like the kind of top line of that is actually one of the other key kind of pillars of Climb's business. That is probably one of the big reasons why I was excited about it and continue to be, is that we are a point of sale business. So 90% of our loan applicants come to us directly from schools. Mm-hmm. And so what's good about that is, as we know so well, customer acquisition is a very complicated and expensive part of running a lending business. And so if you have a distribution channel that is kind of embedded, where you're embedded in the workflow and, kind of have a contractual obligation between the parties, it scales a lot easier. So just as kind of a side note, that's a part of the business that's really great. And the good news is, what that means is that most students learn about us as they're learning about the programs. Mm-hmm. So truck driving student shows up, they're in the office of the financial aid officer, learning about the program and what it could do for them. And then at some point they inevitably say, how do I pay for it? And then they're, we're point of sale wherever the school is. So if the school's an in-person school that has a financial aid counselor, then we're point of sale has a pamphlet sitting on their desk. If it's an online program that has an online admissions app, will be a button in the admissions app. And in some cases, that they click that button, the Climb loan application is already filled out. So we have some, through an API connection with the school, if they have that level of technology. So we're sort of play wherever the school is. Once the student comes in and applies, the loan application is quick, easy, automated, and 96% of the time we offer a automatic decision to the student themselves within the kind of in line with the application. Now, who we approve depends a bit on the school and the kind of whatever loan program we've signed up with them. Because there's another kind of important feature of our business, which is that we have what we call a school guaranteed loan, which essentially has the school participating in the risk of the loan alongside with Climb. So our view is that the student is clearly taking a risk, right? They're like dropping on the workforce and, going to the school, paying money, getting a loan. It's not a huge loan like some people get, but let's say $10,000 on average, with the expectation that they're going to be able to get a career on the other side. We as the lender are obviously taking a risk because we're lending money. And historically, in the example I gave at the beginning, schools just get all the money up front.
Right.
So by asking the school to take a risk share, we align incentives so that the school is then actually paying attention to whether or not students are able to paying attention to the amount of money that people are borrowing as it relates to the amount of money that they're going to make on the other end. Because if it's out of whack, then people aren't going to be able to pay. And now the school has a financial incentive to care about that.
Mm-hmm.
And so the way that works practically is that if a student, we basically advance some portion to the school based on the credit mix we expect to see at that school and based on kind of the school's financial situation. So we create essentially a custom product for every school that we work with to make sure that they can approve as many students as they need to based on kind of their credit profile, but they're still, getting enough of that kind of upfront money to be able to run their day-to-day business.
And so do you work on the credit profile or do you, like the credit model that you're creating, are you working on that together with the school? Because take the truck driving example, these might be pretty unsophisticated, low wage people. They might have been, doing some manual labor before, and they might not have very good credit. So how do you go about building that model?
Yeah, so when we enter a new industry, we have kind of a base model that we use. And when we go to enter a new industry, we kind of learn we learn usually pretty quickly what the credit makeup is going to be. A lot of schools kind of already know because they maybe had students on internal payment plans or other kind of, less favorable to them, I would say, products,
Mm-hmm.
and a lot of times less favorable to the students as well. And so we're able to figure it out pretty quickly. But we have sort of like a base model that we sort of go with, and then we can adjust over time.
Okay, so then what are we talking about as far as interest rates, loan term amount, that sort of thing? What are your? I know I'm sure it's a range, but can you give us some of that range?
Yeah, so our average interest rate is around 8.5%. Our average loan term is a little over $10,000, and the average term is about 3.5 years. In terms of the term, we typically start with a low monthly payment, like an interest-only type payment while the student is in school and for a period of time after for finding a job. And then we flip to principal and interest, which is typically 3 years. We do have loans that go all the way out to 7 years, and that just kind of depends on the program. So for some of the allied health programs we work with, nursing programs, they tend to be a little bit longer, slightly more expensive, but obviously there's better, there's pretty good salary outcomes and lots of jobs on the other side. So we find that it's slightly more affordable to go with the longer term loans.
Right. Okay. And then I guess how many states are you in, and are you using an originating bank to partner with to issue these loans, or how are you doing it state by state? What's the story there?
State by state, and we are in all 50 states plus DC and Puerto Rico.
Well, someone's been busy on the regulatory side in your company.
Yep.
Okay, so then,
that's a lot of the work that I did at Orchard was on that side. I learned, and also working in banking, you learn a lot about that. So as the COO here, I kind of set up our licensing infrastructure.
Right.
But it's not a negligible amount of work, but it's great to have the flexibility and the actual assets yourself and to be able to keep all the economics.
Sure. It makes sense. So then, firstly, how long have you been, when was the first loan issued, and sort of give us some sense of the scale you're at today?
Yeah, so our first loan was issued in 2014. We will pass $100 million in cumulative originations this year. So growing pretty fast. All of that's through our network of over 70 schools now that we have, and across about 30 different disciplines.
Mm-hmm. And so what about the other side of the equation, the funding side of your business? Where are you obtaining your capital for these loans?
Yeah, so we right now, we have partnerships with various like asset managers and funds where we sell essentially groups of loans from our individual schools to them for, the the cash flow.
Okay, so like a forward flow type agreement. Okay.
That's right. That's right. And we did that intentionally because that has enabled us to stay, because we have that risk share structure with the banks, that's enabled us to stay equity light. So we didn't need to raise, kind of like expensive equity capital in the early days to then turn around and lend out. We didn't have to do that. So it's been a good model for us in order to sort of be able to invest the equity capital more in scaling and building out the technology and the services for schools and students.
Right. Well, we're pretty much out of time, but before I let you go, I'm curious to know if I can hear in your voice that this is something you believe in and you're passionate about it. So what is one project you're working on right now that you're most excited about?
Oh my goodness, that's so hard to answer. But I would say, I'm going to give you two things.
That's fine.
But I would say number one is just is on the sales side. I stay pretty tightly involved with the sales process and talking to schools that we are bringing on, and then as we work with them, and it's amazing how great some of these schools are. It's a totally underserved market, but they work so hard to try and do the right thing for their students. Mm-hmm. And you really see it when you're out there. And these schools are all over the country. So I'm traveling sometimes to, places I never would have traveled to when I was at Orchard, Tulsa, and Indianapolis, and all over the place. And you see, these schools that are just totally transforming people's lives. So, mm-hmm. I mean, that's not like a project, but that's the part of the job that I think is really, really fun. But the one project that's been really interesting, and we're just getting started, is starting to work on some corporate partnerships. What we're finding is that in certain industries where there's a really big skills gap, the corporations are so incentivized to have relationships with the educators so that they can get access to the students. And since we have a network of educators and have relationships with the students, there's sort of interesting partnerships that we can do, even as simple as, partnering with an employer. They then connect us to the schools that they work with, and then we, advertise their jobs to our students in a graduation email. Even just something as basic as that. But I love the idea of really being part of the full cycle of employment, because I think that's, at the end of the day, the problem that we're really trying to solve is getting people jobs. And, if you can have access to the employer network that's eventually employing people, that just, I think, makes us stronger from a knowledge perspective, but also in terms of the services that we're offering.
Right. Well, indeed. Well, that it's certainly a noble cause, and I think that this is something that I think is desperately needed at all levels of higher education. But anyway, I appreciate you coming on the show today, Angela. It's great to chat with you.
Great, thank you, Peter.
Okay, see ya.
Bye.
I just want to go back to revisit what we were talking about earlier about the student loan problem. And it's interesting to see Climb Credit's approach. And I think, the whole idea about school these days getting a higher education degree. And a lot of times it's not, there's not a real data-driven approach, and not that should be the only thing that comes into the equation. There's obviously people that are going to be very passionate about certain things that may not be economically all that valuable, and that's totally fine. They can make that decision, but they should make that decision with their eyes wide open. And I'd like to see people who are really looking to improve their lives and wanting to see what is this $100,000 in student debt going to be worth it? And take into account the profession, the school, and we really should have a complete data-driven mindset here, I think. And that's, to me, the only way we're going to solve the student loan problem is if people start really thinking about the fact, is this loan going to be worth it? And it may not. It may be more worth it to go and go to a sort of a different kind of vocation like the schools that Climb Credit work with. Anyway, lots more to say there, but I think I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lendit Fintech USA 2019, the world's leading event in financial services innovation. It's coming up on April 8th through 9th, 2019 at Moscone West in San Francisco. Registration is now open and we're also taking speaker applications. You can find out more by going to lendit.com/USA.